Hey everyone, Jonathan Wu here from SWU Online Invest for our August 2023 market updates. So for the second quarter 2023, China's GDP growth recorded 6.3%, which was lower than expected, but in absolute terms was still quite high compared to the second quarter of 2022, when, if you recall, the Chinese economy was broadly in lockdown. However, this still serves as more of a floor for the government rather than a ceiling for achieving growth for the rest of the calendar year. In saying this, the Chinese government has been rather slow in rolling out broad-based stimulus, but in the last month we have seen them drop the prime rate, which is their key loan rate, as well as cut stamp duty for share trading to hopefully provide some further confidence in the market. Ultimately, these levels of rather poor sentiment are reflected in valuations, and for active stock pickers, it's certainly what we call a stock picker's paradise. Globally, interest rate hikes are pretty much nearing its end, and we will likely to see that rates will begin to decrease next year, particularly if a recession occurs or if already one is underway. Ultimately, most people will realize that the share market actually bounces before the end of a recession. But the reality is that you don't know when the recession started or finished until it's actually over. But regardless of whether it is soft landing or a severe recession, the IC never attempts to time the market, but instead tries to base its investment decisions on identifying sensible risks and opportunities, particularly when there are readily available gains. This is why investors throughout the cycle should not try to time it, but ultimately, if you have a longer term investment horizon, you should remain invested throughout the market cycle. What you see here in this chart is that it looks at what share markets' performance are like, basically depending on the level of recession there is, whether it be 3, 6, or 12 months after that recession, or if the recession never ever came about. And what you can see is you have no idea how to try and time the market, because even if there is a recession, there are 4 different types of recessions. And these recessions ultimately cannot be reflected upon after those returns have come or not come at all. The final thing I want to talk to everyone about is, how does an actual recession occur, and what does that cycle look like? Because most people probably who invest via our platform have never seen a true recession. And a true recession was probably seen during the GFC. COVID was a pandemic-induced recession, so that doesn't really count. But for those who have been around long enough, the longest and probably the most severe recession we've had in recent history will be the one in 1991 to 1993, when Paul Keating was actually the Prime Minister, and he called it the recession that we had to have. Now, how a recession rolls out, you can have a look at this chart. And this chart simply shows the story of what we call hope. So there are 4 parts of the economy that actually slow down over the course of around 24 months for it to play out. So the first part of the economy that responds to a recession is housing. The housing sector responds first because generally rates have gone up, and with rates have gone up, then housing starts to slow. That's talking about new constructions, and also prices start to fall. The second part of the hope is the O part, and the O represents new orders. So if housing slows because rates have gone up, new construction slows, new orders for new goods also start to slow. If new orders start to slow, then you go to the third stage, which is profits. You'll start to see in the next 6 to 12 months, especially ASX listed companies, that their profits are going to be not as attractive as the previous comparable period, because new orders have fallen and consumers aren't willing to spend. And the last part, which is the part that's probably puzzling everyone in this current recession, is the issue of unemployment. We still retain to have a very tight labour market, but employment and unemployment is still relatively low. And this ultimately is the most lagging part of recession and the last part of the economy to fall. So once we start to see unemployment really creep up, and in Australia, the neutral unemployment rate for the government target is around 5%, 5% means there's still slack in the economy, which means that if people want to find a job, it's still available. But it also means that the demand for labor is relatively static. So we are not in a wage price spiral, which is what we're currently facing. For the month of July 2023, the income booster portfolio performed 0.81%, and you can see the other time period performances on your screen now. With regards to the income booster, as most of you know, the target is to try to generate primarily income for investors, but it doesn't preclude us from investing in markets where there is the potential for capital gains. And what you can see here is sort of through the last 3 months, from April, May through to July, because sort of skipped a month just to jump forward a month, you can see that the actual income yield from the portfolio, because it's well diversified, is growing. It's growing in line with the fact that the RBA is increasing rates, but furthermore, the investment committee is on the lookout for more and more high yielding investments. But remember that a high yield doesn't necessarily mean that we're going to be paid based on the same commensurate level of risk, because there's always risk in the market. And when there is risk, we don't want to take excess risk just because the headline yield is more attractive. So what you can see here, just to provide our investors with more transparency, is that each of the individual funds that you see that make up the income booster portfolio, their income yield is anywhere from 3% all the way to 10%. And it is very, very tempting to put all your money into a 10% basket. But the reality is that that's not going to derive a good outcome for investors if the focus is purely on, regardless of whatever the level of risk, just to get that highest level of income return. So you can see the investment committee is building upon this month by month, and hence we're getting quite close and or achieving our target of the cash plus RBA cash rate target income return.